Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Stephen Bailey, manager of the Liontrust Macro Equity Income Fund. Hello, Stephen.
Hi.
So what's the first stock you'd like to highlight today?
I think GlaxoSmithKline has its detractors currently. When you look at the valuation of the company, it's exceptionally modest. There's been a clamour from activist investors to sort of split the company up, and I would suggest that that's certainly a strategy that was likely to be followed, but perhaps not for a couple of years as yet. You know, you look at the components of their business and you actually realise they have a very, very robust global healthcare business, a very robust HIV business. And when you analyse the sort of the valuations that these standalone companies could attain, you realise that there is a lot of hidden value in Glaxo. And of course, in the meantime, you've got to stop paying 5.5% in terms of dividend. It's paid quarterly to investors, which I think is also very attractive in this modern world. And at the end of the day, you know, some of the detractors were highlighting that dividend was uncovered last year. That's a very sort of a short-term event. It is actually going to be covered in 2016. And I would suggest at these levels, it's very attractive.
And you say there that it is good value and it has got further to grow. Is that growth purely from the fact that it will re-rate to fair value, or are there fundamentals within the company that are offering growth as well?
Fundamentally, I think there are some very attractive parts to SmithKline. It's got a very attractive portfolio of drugs in the pipeline, and I think that's often overlooked. I think at the moment, though, you're looking at a year of change, as you are with AstraZeneca, and I think it's a question of actually the business returning to growth as we see new drugs come to market, replacing those drugs that have recently gone off patent.
And what's the second stock you'd like to highlight today?
Legal & General. Legal & General is part of our sort of broader theme on ageing populations, and indeed the incentives that we're seeing and the encouragement that's being given to the individual to save and invest for their future. And I think legals are at the forefront of this market. They've got a very, very cost-effective investment management arm. They've obviously exposed to the workplace pensions. Recently, they've actually gone into PRS, you know, the private rented sector. And I think it's a very inventive business which is adapting to the time. And I think from an investment perspective, you've got a very highly cash generative business, and the yield is actually in excess of, I think, 5.8% currently. And I think, you know, cheaply rated on a PE of 12, it's suffered, I think, as most financials have ahead of Brexit. But I think, as I say, it is offering excellent value. And
a lot of this sector got really bashed last year when we had the news that, or the year before rather, that pension freedoms were going to come into play and potentially taking away some of that market, that retirement market. Have you seen that sort of all level out now, or it's looking at other opportunities?
Yeah, I think the second part of your statement there was the correct way of looking at it. I think initially everyone was worried this was going to be a very costly change for the industry, but they've all adapted to it accordingly. And of course, legals have actually, you know, decided to go into the bulk annuity business, which is exceptionally attractive as far as we're concerned. And of course, corporates are going to continue to seek to sort of shift responsibility from their balance sheet. And of course, the likes of Legal & General are actually best prepared to take that off of them.
And what's the third and final stock today?
AT&T. As you know, we've got a very global outlook on our macro income fund. AT&T is the American equivalent of British Telecom. It's been unloved for years, but I guess that's because it hasn't really been able to sort of demonstrate any kind of top-line growth. You know, aside from that, it has still increased the dividend 32 years on the trot. And currently the stock's yielding around about 4.8%. And I think for a UK investor, it's an interesting proposition, particularly as you've got dollar-priced assets. And I think our concerns are that we're sort of suggesting we're going to have a Remain vote on the 23rd of June. But I think regardless of the outcome of the Brexit vote, at the end of the day, I think sterling will come under pressure in the second half of this year, because we still have some huge question marks with regards to the budget deficit. And I think at the time we're going to be also looking at maybe a leadership challenge for the government. So I think investors are going to start to turn their focus away from the question of Brexit and actually onto sterling.
Stephen, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.